Welcome to Invest Well, Be Well, a podcast for wiser investing and stronger living. I'm Rusty Vanneman, longtime investment professional, and I'm joined each week by my co-host, Robin Murray.
Thanks, Rusty. I'm a storyteller and journalist, and I am so excited to explore the ideas, insights, and people shaping the intersection of performance and purpose.
This podcast is for thoughtful investors and driven professionals who want to grow in their portfolios and in their personal lives.
We'll talk long-term investing, behavioral finance, personal development, and what it takes to live and work with intention.
So let's get started. Let's invest well and be well together.
This podcast is brought to you by Main Management, LLC. Since 2002, Main has been recognized as an ETF strategist that combines an institutional process with the personalized service of a boutique firm. Our guest today is Jurrien Timmer, Director of Global Macro at Fidelity Investments. And wow, what a great interview.
It was packed. And as you mentioned, he is the Director of Global Macro at Fidelity Investments, but he's really one of the most respected macro strategists in our business. And he's also one of the most interesting people in our industry, not only professionally, but personally. And again, what Jurrien brings is decades of experience and a deep, thoughtful lens to market cycles, investor behavior, and long-term strategy. And it shows up in this interview. He's known for insightful charts, historical analogies, and really calm clarity in a very noisy world. And he is a snazzy dresser. But he is more than just a market strategist. He really is a true Renaissance man. He's a global traveler. He's a passionate cook. I mean, he leads culinary camps at Burning Man. He talks about that in this interview. A fitness enthusiast, a swimmer. And anyway, he really lives life with intentionality and curiosity. And so it was action-packed. What were some of your big takeaways?
I mean, I just thought especially his tips about how he lives his life and what is his routine that he has. And he talked about how he kind of grounds himself on the weekends because during the week he has all of these like travel schedules and things like that disrupt his life. But then on the weekends he really like grounds his life with his wife and his routine and his cooking. And I just thought it was a really great way to approach it. And I also loved hearing about his experience at Burning Man and how it's this really cool, immersive thing that he does. It's crazy, but great, and kind of resets after that. And yeah, just really cool to listen to him.
Yeah. I mean, I think if you're listening to this podcast, and if you can, is have a notepad.
Yeah.
I mentioned this to him at the end, is he's got talking points in terms of phrase, which are just gold. And again, I think it's really useful whether you're a financial advisor or an investor. So how about we get into it?
Yeah, let's listen. All right. Well, Jurrien Timmer, welcome to Invest Well, Be Well. It's so good to have you on the show today.
Good afternoon. It's great to be here. Thank you.
Jurrien, I'm so excited for this interview. I've been following your stuff for decades. Our backgrounds have overlapped so many times, and here we finally are meeting. For our podcast, we do have what we like to call our initiation rite, and that is a walk-up song for the podcast to set the tone and tenor of today's interview.
Well, my walk-up song has always been, because I do get this played when I go on stage a lot, it's Watching the Planets by the Flaming Lips.
Yep. Now, when you get that walk-up song, do you get really jazzed up, like almost too excited because you hear it?
Not really, because I'm focused on getting up there, not stumbling off the stage, and whether the person who's introducing me wants to shake my hand or not. So you actually kind of don't hear it when you're the subject. So
I don't have that problem. Usually when I have a walk-up song, I get too fired up. I almost need to have something super mellow. But anyway, that's a great walk-up song.
Yeah. Thank
That's
you.
a pretty good one. All right. Well, Jurrien, we want to talk a little bit about you and your background. So you've been at Fidelity Investments for more than 30 years. Tell us what's been rewarding for you about your career, about working and growing in your career at Fidelity, and also what you do in your current position.
So I'm the Director of Global Macro, which is a title that I completely made up some, 10, 15 years ago. And, it kind of stuck because global macro is what I do. But I've been there for just over 30 years. I've been in the industry for 40 years. Don't let my baby face fool you. I've been around for a while. I got hired 30 years ago, and the most memorable thing about that aspect was that I went to work in the chart room, which is a legendary space at Fidelity. And the former chair, Ned Johnson, who passed away some time ago, that was his baby. And so if you were going to work in his chart room, you had to go by him first in terms of the interview process. So he was my last interview out of whatever, a dozen. And I'll never forget it, and we just talked markets. It wasn't really an interview. It was just a conversation. And the indoctrination into the Fidelity zeitgeist began. And in those early formative years, I was already a chartist, but Ned Johnson was such a purist when it came to charting. Like the lines had to be just right. The lighting in the chart room had to be sort of museum quality, and everything had to be on a semi-log scale. So I really got that education and that mentorship from him and the colleagues in the chart room about, okay, this is how you chart, and charts can tell a story. And really, to this day, I've been working on my craft, which is really to tell the market story through charts. And so that's what I do. I'm a storyteller. I see myself. I kind of bring the walls of the Fidelity offices where we discuss market strategy and asset allocation. I try to bring them to life, if you will. It's been a good gig, and of course we've had, many crises in the markets. .com, the financial crisis, COVID, where not only our portfolio managers are obviously looking for historical context. Okay, what does this mean? How oversold is oversold enough? But it's not just, the investment professionals within our walls. It's the millions of customers and millions and millions of investors, even if they're not customers, who are grappling for meaning and for guidance. And even though I'm not an investment advisor, I can give the perspective based on market history, which is where all my work is rooted in. And if we can just help anyone make the best informed investment decisions that they can, while preventing the mistakes that so many investors make, which is to sell at the bottom because they're following their emotions. If we can do that, then I think that's a major win, because in this country, unlike some other countries, we really need to do it ourselves. We're a DIY investing culture where your pension is what you put in, during your working years, and your company necessarily is not going to necessarily provide you with a pension plan. You have to do it with the help of companies, of course. So that's what I do. And Fidelity is a great company. I've been there for a long time, and they let me help fulfill the company's mission, but in my own way. And to me, that is a successful marriage, if you will, that you can feel that you're really doing it in your own authentic self, while obviously also serving the mission of the company.
Yeah. You mentioned the Fidelity chart room. That is definitely one of the sacred spaces in the technical analysis world. But Jurrien, you have a unique perspective that you're well known for, combining history, macro analysis, and behavioral insights. And you do what I think a strategist is supposed to do. You're supposed to be thought-provoking. How did that worldview develop? Was there a formative moment in your career that shaped your approach?
I always like to say life is an iterative process, and certainly my craft, or anyone's craft, I think is a process of iteration and trial and error. Like, right? If you're on Windows version 10, there was a version 9 and an 8 and a 7. And so these are all iterations. And so for me, I came in 30 years ago as a fixed income technical analyst. Talk about a narrow world, and I came in, this is early 95, at a time when we had that massive bond bear market in 94 when Greenspan was tightening. And so making, bold duration bets in the bond market was no longer that welcomed anywhere, but certainly at Fidelity, the focus became more on the micro and on buying, certain credits or not other credits. And so I quickly found the need to reinvent myself and go into sort of more of the cross-discipline world of equities and currency and commodities. But even then, going around the offices. We were at One Federal Street at the time. And, this is like the rite of passage of being a new analyst, pitching ideas to PMs. Can be a little intimidating because we have some of the most brilliant people on the planet, on those floors. And I had some pretty serious imposter syndrome at the time because in my own view, all I was really doing was drawing lines on charts, right, as a technician. And I don't mean that to demean technical analysis because, I am a technician, but I felt like, okay, I'm going to someone running, a $20 billion equity portfolio, and I'm just drawing lines on a chart saying you should do this or that when they spent all their time kicking the tires of these companies and thinking about what they do, earnings and margins and stuff. So I felt like, okay, I need to do more. So I went cross-asset, and then I started to go cross-discipline. So to me, a chart is a chart, a time series is a time series. It can be interpreted no matter where it comes from. It doesn't have to be price and volume. It can be earnings. It can be valuation. It can be interest rates. And so I started to weave a sort of more holistic approach together where essentially anything was fair game, and I wasn't bound by the dogma of specific disciplines, right? So I'm not an economist, so I'm not thinking about it, okay, this is the monetarist economical way of looking at this. I wasn't bound by those limitations, at least that's how I thought of it. And it allowed me to kind of build a fairly eclectic, holistic approach to understanding markets, always rooted in historical analysis. Some of my data goes back 1,000 years. So I look at a lot of cycle stuff, price analogs, things like that. And then I guess my inner chef started to come out too, because I like to cook and I like to plate my food because I want my guests to taste the food with their eyes before tasting it, actually tasting it. And so really working on the visual presentation of the material became kind of a hobby, a sort of a creative place for me. And, some users of the work want to see numbers in tables, but I'm on the view of, a picture can say 1,000 words. And so I started really getting into, okay, how can I make a chart that tells a story? And, I went to Edward Tufte's class, who of course is the king of charts. And I really got into that. And even now, having done this for so long, I still spend a lot of sort of idle time noodling on charts. I'm like, okay, how can I tell this story a little bit better? And so that becomes the creative outlet to not only have the quantitative information content in my product, but also that communication side.
We overlapped a few years at Fidelity, and during that time, I think I took a Tufte class as well. We might have been in the same class.
But his stuff is great, right? So, yeah. How many Excel chart crimes have you seen, right? Chart crimes and misdemeanors, right? So a tiny chart where the labels and the grid lines are way like too strong, and the content sort of gets lost. And so Tufte would always say, like, the grid line should be like barely visible. It has to be like a light, thin gray. And so I do all of those things. And all the labels, the titles are the same font, the same size. And I want the content to like shine through. But but not everyone has the patience or the time to do that. But my kids are in their 20s, they're out of the house. I've got time to kind of, have fun with these things.
I still have the chart by Tufte that showed Napoleon going into Brushhead back. I have it framed somewhere in my house. Not in this room, but...
So you mentioned that historical perspective that you take with your data and your storytelling, but that can be kind of tough in today's sort of world of 24/7 news, noise, real-time market data. Can you talk about what that long-term thinking really means to you?
Yes. So it's trying to discover the signal to noise ratio, I guess. And we see this, right? We see social media, not to name names, but there's a lot of stuff out there that where the signal to noise ratio may not be the highest, and especially on some platforms, and I saw this when I got into when I went down the Bitcoin rabbit hole, some 5 years ago, that, okay, wow, there are a lot of strongly held opinions by people with 1 million plus followers, but that doesn't mean that they're the best formed opinions. I'm not to be judgmental, but so I'd want to be that voice of reason. And people have commented on that with me. Like some people want that big bombastic call, like buy or sell, crash or boom. And to me, that there's not a lot of use in that. These binary calls, you got like a 50-50 shot of being right. And it's not how people, in my view, should be making investment decisions. So my stuff can seem a little hedged or nuanced or boring, but I want to help people make the best decisions, giving them the tools to make those decisions. And so there are no easy answers. People have to do it themselves. They have to do this with conviction so that when whatever market they're investing in, when it draws down, they have that sense of conviction that, okay, I can bear through this. And so oftentimes there is not maybe a satisfying answer, but if I can just provide bits and pieces of historically based evidence, if you will, to help people put their own investing puzzle together, then I think I've done a good job. And so that's really what I try to do, knowing that I'm not there to get clicks or followers. I'm just there knowing that we have a lot of investors who consume their information there, and that there are a lot of, kind of bombastic opinions out there. And I want to be the antidote to that and provide people with that balanced perspective.
Well, you definitely create a lot of great and useful content. And you recently created a short and very fun video called Invested, Not Stirred. And in it, you talk about secular cycles and how various factors play into market behavior. Where are we now in the current cycle, and what should long-term investors be paying attention to?
So that video, just as a sidebar, we obviously, like anyone else, there's a whole generation of young investors out there who, of course, we want to curate to, and who may not be getting their information from the traditional channels that maybe you and I have over the years. And so these TikToks are one attempt at sort of, having someone with experience be on there may perhaps make a fool of himself in doing it, and to just kind of unpack the investing basics. And so the differentiation between cyclical cycles, if you will, the business cycle, and secular trends, which are super cycles spanning multiple individual business cycles, I think is an important consideration, because those secular trends can provide very strong tailwinds or headwinds, right? So the 2000s was a secular bear market. The market barely made any progress over 10 years. We had the dot-com bubble in there, the housing crisis or the financial crisis. And since that time, in my view, we've been in a secular bull market, which tends to produce well above average returns consistently. And so over the past 16 years or so, and not every technician agrees with me that the secular bull started in 2009. They think it's more likely to be 13 when the market made a new all-time high. But to me, it's a nuance. But for me, the last decade and a half have produced outsized returns of about 16% per year. Obviously, we have the whole Mag 7 story in there, the dollar hegemony, U.S. exceptionalism. That's all part of the same trend, right? Rising margins, rising PEs, share buybacks being a very large component of the big companies, which produce a lot of free cash flow, returning that cash flow to their investors via buybacks. And so I try to look at things like that to understand what the big picture drivers are. And by most accounts, that trend is still underway, right? The buybacks are still there. The margins are still high. The U.S. exceptionalism, which certainly this year is getting challenged a bit, but is for the most part still there. What we don't have, of course, is the easy money era that defined a big part of that trend. So that's certainly a difference. Rising interest rates is something new, but that's kind of the long-term tailwind. And I think that wave is probably in the process of cresting. Doesn't mean it's going to abruptly reverse. The average secular bull market lasts about 18 years. We're at 16, with the caveat that the sample size is very, very small. But I think we're still in there, but we're in the later innings, to use a baseball metaphor. And certainly if the global world order is being challenged, as it is in terms of what's happening, in the U.S. political scene with trade, protectionism, things like that, if that really gains momentum, and so far, it gained momentum back in March and April, and then it was sort of pushed back a little bit because the markets protested it a little bit too much. But if that really is the start of a new global world order where fewer dollars are going around the world, getting recycled back into our own markets, then the U.S. might lose some of what I call its supremacy premium. Doesn't mean the U.S. is going to be a terrible place to invest or anything like that, but I think the U.S. has always been kind of the cleanest dirty shirt, if you will, in terms of the debt dynamics of the developed world. And, obviously in the U.S., we're talking about the big, beautiful bill and what that does to deficits. It's going to increase the deficit by about, $4.5 trillion. And whether that's, a bridge too far. Of course, Europe, Canada, the UK, China, Japan all have the same issues. They have slowing demographics, rising debt levels. But the U.S. as the reserve currency and as the most dynamic economy has kind of gotten that get out of jail free card for a while. And that, I think, is being questioned right now. And you see that in the behavior of gold and of interest rates, the term premium in the bond market. And so to me, that is one of the bigger, more juicy sort of things to ponder, because that is not a 6-month trade. That is a 5 to 10 year strategic event that, if it happens, that will define kind of how we allocate, not for the business cycle, but much beyond that. So that's the strategic secular view. On the cyclical side, we've been in an expansion now since COVID, so 5 years in. Business cycles over the decades have gotten longer because the economy has become less manufacturing based and more services based, and now even just more IP based. And so business cycles have gotten extended. Now we're averaging a recession maybe every 10 plus years, as opposed to once every 4 years back, 50 years ago. And 100 years ago was one every 2 years when it was an agricultural economy. It really was a boom bust economy. So business cycle is intact. It's pretty amazing that we had COVID, we had this massive inflation wave of the CPI going up at 9%, and the Fed, who I have a lot of respect for, got that inflation rate from 9 to 2.5 without producing a recession. I mean, that's a pretty remarkable feat. Maybe they had nothing to do with it. Maybe it was just always going to happen that way. But I think that speaks to the fact that the U.S. economy is a lot less interest rate sensitive than it has been in the past, right? Banks, so in the past, you would get an inverted yield curve because the Fed was tightening too much. That inverted yield curve always led to a recession, because an inverted curve means banks are not being incentivized to lend because they borrow short, lend long. And if short rates are above long rates, they're not going to lend. So you get a credit crunch, so you get a recession. But when rates rose from 0 to 5 and 3/8, guess what happened? Bank deposit rates went from 0 to 0.5%. And so if their cost of funding is whatever they pay on deposits, right? Because it's deposits that lead to their loan book. The banks have a very steep yield curve. And so they're liking this. And that's why the banks are very profitable right now. And the same thing with homeowners and corporates. They termed out and refinanced their debt back in 2020, 2021. So the economy is not as interest rate sensitive. The biggest sort of victim of high short rates is the government itself, which has to borrow a lot of money because of the deficits. And we see that play out in the news. So the business cycle is intact. The economy is slowing somewhat, but not enough for us to worry that a recession is imminent. And so we're in an era now where the baton has sort of been passed from focusing on the Fed and monetary policy as the main driver for the business cycle to now fiscal policy, which is what I would call dominance. So it's called fiscal dominance, meaning that fiscal policy is really driving the bus more so than monetary policy. And this is why what's happening on the long end of the yield curve is really the most important indicator, I think, right now, in addition to the US dollar.
So while Robin and I typically just ask questions regarding investment principles and personal practices to enhance decision-making, I do have a couple follow-ups on these comments. So in particular, what is going on? You mentioned gold, but also in the dollar. And what does this all mean for asset allocation moving forward, especially when the traditional models like the 60-40, 60% in stocks, 40% in bonds is being challenged?
Yeah, that to me is really the big existential question mark that I'm focusing most of my time on in trying to determine if a new investing regime is upon us. And so just to dial back for a moment, the 60-40 paradigm, 60 equities, 40 bonds, is kind of how we all grew up, right? Most investors with any kind of assets these days were educated in that paradigm, if you will. And if you're a US-based investor, so if your liabilities are in dollars and not euros or yen, over the past couple of decades, until 3 years ago when rates started to rise a lot, really all an investor had to do is own S&P 500 and the Bloomberg Barclays Agg, which is the US investment grade benchmark. And you got 9% with a 9% volatility. That is a risk return that most people can live with and was well above the inflation rate, right? The inflation rate from the late 90s until 2021, when this paradigm really ruled, was maybe 2.5%. You got 9%, so you got 6-7% above the inflation rate. But that 60-40 paradigm is completely predicated on the assumption that bonds are inversely correlated or negatively correlated to stocks, right? And the point is, equities are the anchor. They're driving the bus in terms of your returns. Really, nothing compounds like equities over the long term. The price for that compounding, of course, is that every other year you get a 10% correction. Every 4 years you get a 20% bear market. So that volatility or those drawdowns are the price of admission, if you will, for gaining that 10-11% over time, which over decades really compound in a meaningful way. And so the 40 came into place just as an insurance policy against the 60. So the 60 drives the bus, the 40 prevents accidents, if you will. So that only works, of course, if the 40 is negatively correlated to the 60. And from the late 90s until 2021, that's exactly what happened. But there have been many, many decades before then, and certainly the last few years since then, where bonds have been positively correlated to equities. Now, that doesn't mean we shouldn't own bonds, because bonds are paying 2.5% yield after inflation. So you're getting, it is a store of value, right? It wasn't during the time when the Fed was at zero rates and other central banks, and we had what I call financial repression. During those times, the Fed pushes real rates below zero, and then you lose money owning bonds. But people still own them. It still made sense to own them because the correlation between bonds and stocks was like minus 70%. So it was a very expensive insurance policy, if you will, but that insurance policy really paid off. So now we're kind of in a different regime, and I don't know if it's going to stay there, but right now that's what we have, is that you're now being paid to own bonds. You're getting a positive real yield, but it doesn't necessarily protect you from the 60. So to me, bonds become their own viable asset class. They are very competitive now with other assets. They're competitive with stocks, right? If you take the yield on a 10-year treasury, it's 4.3%. If you take the inverse of the PE ratio of the S&P and you express it as an earnings yield, it's about 4.5%. So the risk-free asset, as we think of it, is very competitive with the risky asset. And that is a paradigm where bonds generally are correlated with stocks. So thinking about the 60/40, then what do we do with that? And again, this is not investment advice, but this is my own back of the envelope stuff. But the 60, of course, I think is still the anchor. Maybe it's not all U.S. stocks. Maybe it's a more global allocation now because other parts of the world are much cheaper in valuation and now have a catalyst to potentially compete with the U.S. exceptionalism. But maybe that 40 in bonds is too much because if the correlation is positive and if it's actually hiccups in the bond market causing hiccups in the stock market rather than bonds providing a reprieve from hiccups in the stock market, then maybe we need to look somewhere else for at least uncorrelated assets. So there's nothing really out there that is negatively correlated anymore. But if you get into gold, Bitcoin, cash or cash-like strategies, when the curve is flat and high and the Fed is unlikely to cut rates to the degree that it has in the past, some cash actually can be a competitive building block for a portfolio. And then you get into, maybe tips, because if maybe inflation goes up, alternatives like liquid alts, like hedged equity, like long-short strategies, managed futures, absolute return, like just a bunch of things that, small amounts, but that together provide enough building blocks that might move independently from both the 60 and the 40. So I think of it as a 60-20-20, where the 20 is just sort of a bunch of things that are uncorrelated. And gold, to me, is a powerful anchor in that because, bonds historically tend to do better than gold. Gold doesn't have a coupon, so you can't clip the coupons or compound them and, reinvest them. But the times when bonds have done poorly, gold has done exceptionally well. And so the way I would clip gold's coupons, even though there aren't any coupons, is that if you put, let's say, 5% of a portfolio in gold and bonds do poorly and gold does well, that 5% might become 10%. And then you rebalance back to 5. And that is a way to kind of monetize the gains in gold, even though it doesn't spawn an income stream. And so that's kind of how I think of these things. But, your question about the dollar, gold are fascinating because 3 years ago, so gold always traded as the inverse of real yields. So if real yields went down or went negative, gold would go up, which makes perfect sense because gold is a store of value. And if real yields are negative, you are losing purchasing power in bonds. And so gold then becomes the antidote to that. But 3 years ago, when rates rose and real yields went from negative to positive, gold should have gone down a lot. It should have gone down to like 1,000. Instead, it doubled to 3,500. So it disconnected from this old way of valuing gold and is now trading, I think, on the basis of countries buying gold as their reserves. And of course, part of this was the Russia-Ukraine war and assets in Russia being frozen. In the eyes of some countries, that would be a weaponization of the US dollar. And so other countries are like, okay, well, I'm going to maybe put not all my eggs in one basket and diversify my reserves and buy gold. And so that clearly has happened. China has been doing that. Russia did that as well. But then in addition to that, if a new world order of deglobalized mercantilism, let's put it that way, means that the U.S. is no longer going to be that consumer that sends all their dollars out overseas, and then those dollars end up in central bank reserves, which then get reinvested right back into our markets. And over the years, $30 trillion has flowed into our equity and bond markets from international investors. If that were to reverse or at least no longer grow, you could make the case that the dollar's status of the dominant reserve currency erodes a little bit. Like it wouldn't stop being a reserve currency, but it's already gone from 75% 20 years ago to about 58% today. Maybe that continues to erode, and all of a sudden we're at 50 or 45. which wouldn't be the end of the world. But in that scenario, that premium that the U.S. has enjoyed, right? A low term premium on bonds, a low risk premium on equities, and a strong dollar, some of that could go away, and the global investing landscape might become a more level playing field. So I think that's a tremendous opportunity because it means that all of a sudden the other half of the global equity market becomes investable again, right? So it creates a lot of opportunity, but it also comes at some risk because if rates rise because of this, then that will impact the PE on equities because the risk-free asset is competitive. And if the dollar sort of slowly erodes some of its value, for U.S. investors, that's not an issue, especially if they're invested abroad, then you get the currency translation. But it's potentially a new world order. And the action in gold and in the dollar, especially in the last few months when the dollar would go down during periods of stress rather than go up, which is what it normally does, is a tell that maybe a new regime is afoot.
This episode of Invest Well, Be Well is brought to you by Main Management LLC, a pioneer in actively managed ETFs since 2002. Main Management starts with a clear fiduciary focus, delivering the transparency and personal attention you'd expect from a boutique firm. They provide financial advisors with solutions, not products. Main also believes investors should keep more of what they earn, emphasizing net of fee after-tax performance to help clients retain more of their returns. I've known Main Management for years. I've met thousands of managers over the course of my career, and one quality I really value: they invest alongside their clients. They eat their own cooking. Over 10% of the assets they manage are their own partner assets, and more than half of the firm are partners themselves. That says a lot. To learn more about Main strategies, including buy right hedged equity, U.S. sector rotation, thematic innovation, and all asset models, please visit their website at mainmgt.com.
So I want to step back for a minute. As you said, in your work, you really are a storyteller, right? Through the charts that you create. So can you talk about what your process is like, how you use analogies, historical charts to communicate complex ideas, and how important is narrative when shaping investment strategy and also guiding investor behavior?
I think narrative is very important. We can call it conversational alpha, maybe, and so, I mean, storytelling is obviously a very powerful thing. And in a world where there's so many data points, there's so much information blasting at us. And these days, we don't even really know anymore what is even true. I mean, we're kind of in this very divisive political world, and where if someone is promoting a viewpoint, whether it's politically or on the markets, the spin that gets put on that can be very detrimental, if you will. And so, there's the old saying, there's lies, and statistics, or I forget how it goes. And so a bad backtest of data can be very dangerous because it can lead people to make wrong conclusions. So what I try to do is I always try to be objective, impartial, let the history speak for itself, let the data speak for itself. Everything is data focused rather than opinion focused. And so, during the week, I'm on the road a lot. I do a lot of traveling. I was just in Europe for 2 weeks doing a roadshow through 5 countries, talking to CIOs and PMs and investment advisors and treasurers. And, you hear what the concerns are. And I work with some extremely bright people in our asset allocation group. One person does high yield and convertibles. One does investment grade bonds. We got equity people. We got asset allocators. And so based on what is happening in their world, and the questions they ask me, I get a sense of, let me see where this goes. And then, like I said, it's an iterative process. So just yesterday, right, it was quarter end a few days ago. So I've got like daily charts. I got weekly, quarterly, monthly, quarterly, annual. So I'm like, okay, it's quarter end. It's first half of the year. I'm just going to start digging into my quarterly charts and indicators. And then I read something about, central banks and gold, which we just discussed. And next thing I know, I spend like 4 hours just sort of noodling on these things and looking at data and seeing, where the relationships are or aren't. And a lot of it is sort of this trial and error stuff where you feel like you're wasting your day just kind of goofing around with this stuff. But that's where a lot of really good ideas come. And not to compare myself to an artist, but I would imagine someone who's a painter is probably doing similar things. They just start trying things and it's okay, well, this is terrible. But here, okay, now I've got something. And so it's a chaotic, creative process, but still built, based on data and real-time questions that investors have, whether they're end investors or my colleagues, and of course, based on what I read and the events that are happening in the world. And so it's just kind of this mix of inputs and impulses. And then my weekly routine is Saturday, I do a complete download of all my stuff. And people always ask me, why don't you let AI do that? Like have a bot update your charts. But to me, it has to be manual and messy because as I do that, it records it in my brain, basically, right? So I'm in the media a lot. Like you can wake me up at 3 a.m. and I can be completely rational on a TV appearance because it's always in my head because I do this every single week. I publish every Sunday and I download every Saturday. And again, sometimes it's what I do, and this again sounds a little cheesy, but I go through hundreds of charts and maybe 10% of those charts, I feel like, oh, this chart is saying something. It's speaking to me, like it's telling a story. And then I put those charts on the side. And then Sunday morning when I start writing, I have, let's say 20 to 30 charts that to me are telling a story. And then I create the narrative around that. And then that becomes my Sunday report, which used to be exclusively for our investment professionals. And then compliance took a slightly easier view on it. And then I could start sending it to our people sort of in the field who are client facing. Yeah, we're a highly regulated industry. So client facing versus the manufacturing side are sometimes treated differently. And more recently, we now post that, or 99% of it, in the public on LinkedIn every Monday or Tuesday. And so it's kind of an open source thing, which I like because I want people to be able to benefit from it. But that is my somewhat messy, chaotic, but creative process of telling the story.
You said earlier, and I think you've been quoted on this a few times, and that is that volatility is the price of admission in investing, right? So how can investors better accept that reality and stay disciplined when markets get turbulent?
To me, that is the hardest part of investing, is doing exactly that, right? So creating a portfolio that maximizes the reward for every unit of risk, right? So you think about an efficient frontier, you got the volatility on the horizontal, the return on the vertical, and you have this curved line where you have the efficient frontier. And so you want to be as far to the left and to the north of the chart as possible, right? You want the highest return for the least amount of risk. Of course, there's no free lunch, so those assets don't really exist. Generally, more return comes with more risk, and just to use Bitcoin as an example, its annualized return is of course astronomical, but its volatility is like 70, right? For the equities, for a 60-40, it's like 9 or 10. For the S&P, it's 15, and so constructing the portfolio, it's not simple. It depends on your risk profile, your goals, how many years you have till you need to start drawing down on that money. But you can solve for that, right? And we have an army of financial advisors, and so do other companies, that put all your information into a computer and it spits out your model portfolio, if you will. So that's relatively easy to do with the right tools, of course. The hard part is to stay with that plan. And that is the challenge, because you can have the best laid plan you can possibly get, but there's no way to avoid the occasional drawdown. And the drawdowns can be severe, especially when all the different assets in your portfolio start to behave in the same way, right? Which happened during the financial crisis, for instance. And then it's important to stay the course, maybe use the volatility to your advantage to rebalance, right? Because a 60-40 in a drawdown might become a 50-50, and then you need to go back to the 60-40 and rebalance. But it's a hard thing, because 40% of, the market goes up 60-70% of the time, which means it goes down 30 to 40% of the time. So that's a significant amount of time where the markets are going to make you uncomfortable, because we're all long the markets to some degree. And to me, this is where having a financial advisor actually is very important. I know we're kind of in a DIY type world where we can do everything online, and you literally just have to click one button in a moment of fear, and you have just killed your compounding machine, right? Because then you're out, and then you need to get back in. And a lot of people are like, well, I just get out now and ask questions later, and I can always get back in. But that's not how it works. By the time people get back in, markets at new highs generally, right? And we saw this during COVID. And one of the challenges about market timing, which I used to try to do in my earlier days, I wanted to outsmart the markets, and I gave up on that a long time ago. My 401k is invested in one target date fund. That's how. Now, the people who run the funds happen to be sitting in the office around the corner from me, so I can always go see them. But that's kind of how I've evolved from someone who thinks he's smarter than the markets to someone who is just, I'm going to delegate this out, because the market is always in a process of price discovery 24/7. Price always leads fundamentals. It always anticipates, not always correctly, but it does always anticipate. And the markets will reprice much faster than you or I can change our portfolio. And then you're always chasing yesterday's news. And because price tends to move ahead of the anticipated fundamentals, oftentimes when price does something, it doesn't seem to make sense, right? So during COVID, to give that example, markets peaked in February. Then, of course, they crashed 35%, bottomed in late March. And by June, the market was back at the old highs. And, people were still dying. The economy was still locked. It made no sense for that to happen. But in retrospect, it was exactly right, because the economy reopened fairly quickly. Earnings came back. And so the price action correctly predicted that. But for the investor who sold in February, they probably didn't get back until much later, when the market was at a new high. And then they locked in those lows, and then bought, they ended up selling low and buying high, which is not what we're supposed to be doing. So it's much better to stick with it. And if it means having to pick up the phone and call someone who is hopefully going to, walk you back from the ledge, and even if that service costs you more money than you can do by yourself, it's a small price to pay if that keeps you in the game when you should not be selling.
All right, so this podcast is not just about investing well, but it's also about living well. So Jurrien, how do you maintain your own personal wellness? We're talking mental, emotional, physical, given the demands of your role.
It's a great question. I try to bring my whole self to work. Let's put it that way. And, we work in an industry, and I don't mean to single out Fidelity or anyone else. I mean, Fidelity, I think, does a good job at the whole work-life integration as well. But the financial industry is kind of a left brain industry. And I went through that whole period, kind of like the midlife period, where you start questioning, okay, I'm just doing all of one thing, but none of the other, which is the right brain. I read a lot of Carl Jung, the being side versus the doing side. I started to weave in a better work-life balance for myself, because it's if you are repressing one half of your being and you lock it in the closet, eventually it's gonna bite you, so it's gonna come back and haunt you. So I do a lot of cycling. To me, that's sort of meditation in motion. I've picked up swimming laps, which to me is, it's not always easy to be near a pool or an ocean that is not like below 50 degrees. But to me, swimming laps is an incredibly beneficial exercise. It's like yoga in water, right? It's meditative because you have to do very precise breathing. So it's like a breathing exercise and you're moving. It has no impact. You're stretching, you're circulating. And then, I cook, right? So I like to cook. I'll spend 2 hours in the kitchen cooking just for myself if I happen to be alone. And so it takes me 5 minutes to eat and an hour to cook, but it's in the cooking, it's that creative mindfulness work where you're not, trying to fix all the problems in the world. You're just focusing on getting a good sear on that piece of salmon or what have you. And so it's things like that. And I go to Burning Man, and not to sound like a cliche, but I run a food camp there. I've got my bracelets for this year. So we run like a full commercial kitchen, all free, right? All donated. And we make like 7,000 meals during Burning Man, and we feed the artists who go there. So the camp's called Feed the Artists. So if there's any burners out there, come and see us on the playa. We'll feed you. But that's something that is so different from what I do, even though like it's a nonprofit, right? But it's still it's still running a business. You have to have a budget. You have to line up vendors, and you have to rent a generator. You have to collect dues. But it's a group of people that is so far from anyone I would meet in my like normal world, right? These are brilliant people, but they're from all over the world, every walk of life, every kind of background. And we gather once a year and we make magic happen because we're all these completely different people that are working in the kitchen producing the same mission, if you will. And so it's a combination of those things: cooking, cycling, swimming, the Burning Man thing, that to me provide that they feed the right brain. And also my outfits, we're talking about your jacket earlier. I'm somewhat known for coming to work in very colorful blazers or pants. And I even used to have a thing where when I was on the road on stage, I had red pants and green pants, and people would speculate on whether I was bullish or bearish based on the pants I was wearing.
Was that true?
It was true for a while, yes. Then it became too predictable, and I switched to other colors.
Yeah.
But to me, it's very important, and even like in my reports, right? So I publish every Sunday. I've been doing it for decades. I'll weave in some personal thing. So every week I take a photo of something wherever I am, and that leads off the conversation. I might have an anecdote if I just saw my parents, and my dad's 97, or something, just a little bit of personal, not too much. I don't want to abuse the privilege, but that's a way that colleagues appreciate that it's not just the suit side of me. There's something more, and hopefully it gives people permission. Just maybe not a right word, to kind of bring their whole self to work. And we tend to be in a very fragmented, compartmentalized world, at least in the Western world. Maybe it's different in the Eastern cultures.
So can you talk about a book, an idea, a philosopher, a thinker, anybody that's recently influenced you in investing and in life?
I don't read a lot of investing books. I hate to admit it, but people always ask me that. So when I read, I did read the entire history of the Federal Reserve, which was actually more interesting than it sounds, because this was during COVID. I was fascinated with the financial repression era of the 1940s, when the U.S. obviously went to war, the debt to GDP, skyrocketed, and the Federal Reserve, which wasn't independent yet at the time, essentially facilitated that debt finance by capping rates, doing QE. And of course, during COVID, there were echoes of that. And again, that's where some of this historical perspective comes in, even though history doesn't repeat and no cycle is ever the same. But you can borrow from different analogs and say, there's an element of this cycle that is kind of similar to today. So that was actually one of the more interesting books, because, you look at charts, you look at data, and you hear Fed presidents, talk, but actually going through these books, where it was almost like a day by day, recollection using Fed minutes and things like that was really interesting. But beyond that, when I read, I try to read sort of more right brain stuff. So I'll read and reread books that I read a long time ago. Joseph Campbell, one of my heroes. The Art of Loving is from the 70s. There's a book called How to Fall Apart Without Breaking into Pieces. And so those are books that have so much wisdom in them that you read them, and then a few years later, you want to reread them. And so generally speaking, when I'm kind of have time to really read, it's more in on that side of the equation.
So Jurrien, you talked earlier about, so you're cooking in demanding environments and you're swimming sometimes in open water. So do you intentionally lean into discomfort to cultivate mental toughness, or is it about just reaching a flow experience to reset?
It's the latter. So I don't seek out being uncomfortable or stressed out, but it's the flow experience, right? So again, being in a 25-meter pool and doing 60 laps, that's 1.5 kilometers. That's what I try to swim. It's that flow state, right? It's where you're not, again, for swimming, the breath work is so important. And I'm not like a competitive swimmer. I'm just someone who likes to swim. But to me, that breath work becomes so all-consuming that you don't really have time to be stressed over some other thing. And so to me, that is really the magic of that flow experience, where you can rest the monkey mind and you're not just ruminating, right? I have a saying, if I ever write a book, and by the way, I am planning on writing a book, this notion of ruminations of the ego mind, I think we can get so stuck in that these experiences where you're flowing become very important. So it could be deep work. It could be a Sunday writing my report, playing my dad's Bach records. At Burning Man, you're producing, you're feeding 1,000 what we like to call zombies in one night. It's like, you're like, I'm not a restaurateur, but we are running a restaurant in the desert. And so you don't have time to worry about anything else. You're doing it, you're flowing, you're serving those grilled cheeses or whatever it is. And we got a bunch of Brazilians, dancing in the background, and you're making the magic. And so it's about that. But it does come with stress, especially at Burning Man, when you're running a camp that is based on a lot of infrastructure, right? If you run out of potable water, you're screwed. If the gray water wasn't pumped out, your shower is going to overflow. If you run out of diesel, your generator is going to stop, and that means that your refrigerated container is going to get warm, and all your food, $20,000 worth of food, is going to spoil. So there are all these layers that can be very stressful, but you do it year after year, and you get better, and you know what the tricks are. But it also heightens the flow when it does work, because the stakes are relatively high. But I'm not an adrenaline junkie, but there are moments of adrenaline there.
So apart from sort of those experiences that help you kind of reset in that way, do you have any other kind of daily rituals or tools that help you stay creative and help you conserve mental bandwidth, so that really you are devoting your energy to making those important decisions in your life?
So I have a weekly routine, which I described earlier. So the daily can get a little bit discombobulated sometimes because I do travel a lot. And just in the last month, I was in Vancouver, Salt Lake City, 5 countries in Europe. I go to the West Coast regularly. I have a place in Santa Barbara that we discovered during COVID. So it's not necessarily a daily routine, although I would say that every day that I'm not traveling, I cook. So that actually becomes an anchor. And again, even if I'm by myself or with my partner, it is our ritual. Like, she comes home, she works at MIT, I come home, and we catch up. We're in the kitchen, I'm cooking, then we have dinner. So that is a grounding experience. And then in the morning, we wake up together, we have coffee in bed, and then, we go off to work. But then the work part during the week is kind of all over the place. I'm either doing a TV thing or a podcast, or I'm flying off to somewhere. But again, that weekend then becomes the grounding part. Again, my kids are in their 20s. They live in other places or countries. So I don't have like to do the parenting thing anymore. So that gives me the freedom on a weekend just to be home. And because I travel so much, being home on a weekend actually is the most glorious place to be. I don't need to like do something. I just want to be, in my own kitchen, sleep in my own bed. So I would say that the most steady routine on a day-to-day basis is the cooking.
Pretty cool. Well, Jurrien, thanks so much for coming on the show today. This has been such a great conversation. I think we all learned a lot. Before you go, can you tell us how our listeners can stay in touch with what you're thinking and doing?
Yeah. So again, publish every weekend. It gets posted on LinkedIn. So just look for my name, usually by Tuesday. And then throughout the week, snippets of the material get posted as individual posts, also on X. On X, I'm at Timur Fidelity. There are podcasts that I do that end up on YouTube, and so there's even some content there. And so I'm kind of all over the place, but LinkedIn and X are probably the way to get the most consistent content from me.
So, Jurrien, thank you. I have 2 quick comments and 1 quick question. So the comments are, first of all, on your weekly that goes on LinkedIn, it is outstanding. So everybody listening should check it out. Also, this has been an amazing interview. And I personally think I have a pretty good toolkit of talking points about the market. You gave me so many. So thank you for that. And my quick question is, since I assume you're home now, what are you cooking tonight?
Tonight, I'm cooking, I don't want to call it pizza because the pizza experts say that's flatbread, not pizza. So it's not pizza with red sauce, but it's a flatbread. And I got these Wagyu Bohemian steaks from Italy, not to plug Italy, but they have this great steak. And so I sear the steak, I caramelize red onions, put that on the flatbread, and then a whole box of arugula goes on that, and then on top of that goes the sliced steak. And so that's like our comfort TV food. So we're watching The Bear right now.
Oh yeah.
So we're gonna watch The Bear and have this pizza / flatbread.
Yum.
Sounds like a great night. Well, thank you so much. Hey, we'll be back next week. Thanks for listening to Invest Well, Be Well. Let us know what you think. And if you like what you hear, don't forget to subscribe. This podcast is hosted by Rusty Vanneman and Robin Murray and produced by Garrett Crosby. Well, we'll be back next week. Thanks for listening to Invest Well, Be Well. And hey, if you like this episode, don't forget to subscribe.
If you have feedback, guest suggestions, or just want to connect, please visit my website, rustysbridge.com, or email me directly at rusty@rustysbridge.com. Until next time, invest well and be well.